subsidiary into most of the time. Audit different from a single entity audit. The different because a subsidiary is also a separate legal entity, and the parent is also a separate legal entity. And by all means, when you are auditing group account, expect that you have different audit firms sometimes. The parent auditor and your subsidiary auditor. Subsidiary auditors, no, in some way, they are from component auditors. Component auditors. Now, most of the time, the parent audit firm, or one decide the group audit firm. So, we say parent is different from the group. Okay, I'll say we can do. Until we have group audit. Group accounts, we have the parent, we have the subsidiary. In fact, in other there were sub-subsidiaries. But we are limited to parent and subsidiary. That sub-subsidiary also means that the subsidiary is a parent to the sub-subsidiary. And that means that when you have interest, that was sub-subsidiary. So what I said? I said, me work ever. Now me ban this one. It's a nana. So what I said? It's that you will link. You will link. It's banana. That's how it. So here what it means is that because we have parent and subsidiary, the combination of the parent and subsidiary and the amount of group. So the parent, we will have a parent auditor and a subsidiary, you say, or subsidiary auditors are a kind of component auditors. Component auditors. And here are the parent auditors. Now most of the time, not parent auditors, no, on one side auditing the group, which is made up of the parent and the subsidiary. What's the concept in that? 80. Because there were two different audit firms audited financial statement. Sometimes, no, a critique problem. Now, group account challenges is presenting said group audit technical, complex. It is one of the challenges in auditing group account. It's technical, it's complex. We say also a hard one. Auditing group account is a challenge, it's complex. One year experience. Two, because parents and subsidiary are separate legal entities into it means that they may have different end of year reporting periods. So for instance, I remember some years when I was working in the bank, our parent company was in Trinidad and Tobago. And we have subsidiaries. And in Ghana here, our reporting period January to December. On reporting period this September until August, until on year and September of every year. That's their reporting period. You also say their reporting period December. So you see the difference in how are you able to, consolidate with different reporting periods. That's also a challenge. And also, sometimes in auditing group accounts, there may be how do you call it? Sometimes disagreement because different audit firms and they involved. There may be some form of disagreements. So these are some of the issues Or these are some of the challenges in auditing group accounts. There are several adjustments that you have to make. There are so many adjustments on realized profits, on inventories, on non-current assets. You have to make all those adjustments in your books. So these are some of the issues. Now, let's talk about the group engagement team. As I said, the parent and subsidiary and the money group. Most of the time, the parent auditor and the group auditor. So the group auditor, they will lead the audit. Among the measures, say component auditors, no, the right thing. So here, they are saying that the group engagement team is responsible for establishing the overall group audit strategy. They are also responsible for communicating with component auditors. The group engagement team is responsible for performing work on the consolidation process and evaluating the conclusions drawn from the audit evidence obtained to form an opinion on the group financial assets. So here what we are saying is that the group auditor and the group engagement team, a share auditing now also. For instance, if I say group auditing, KPMG. Most of the time, KPMG now the parent auditor. And I work subsidiaries. Subsidiaries, no, because they are scattered different countries. Into other subsidiary auditors in Deloitte, and I say EY. In that situation, KPMG will control the work of EY. Because at the end, KPMG will be doing the consolidation. So, person said, EY, collaborate. KPMG never provided audit plan, audit strategies. Actually said, EY, follow letter of instruction. In the course of the audit, if they encounter any issue, they have to draw KPMG attention. Because they are the group auditors. It's just like a parent and a daughter. Now, let's talk about component auditor. So the component auditor is an auditor who, at the request of the group engagement team, performs work on the financial statement related to a component for the group. So the component auditors, at the request of the group auditor, they perform the audit work on the subsidiary or on the component. That is the component auditor. And all these things, you all do.
IFRS ní àdàdé ẹ̀rọ.
Ètùwé mu no, IFRS 3 ẹ̀ka sábà dẹ̀ business combination. IFRS 10 ẹ̀ka sábà consolidated financial statement, right? IFRS 11 IFRS 11 joint arrangement. IFRS 12 disclosure of interest. IAS 27 separate financial statement. IAS 28 accounting for investment in. You mean Kasapa also, also. You can see that consumers will understand that. It is another year little bit complex. It's just like the normal audit procedures, like the shares, the same procedure they are applied during the group audit. Because the parent or the group auditor is like the team leader. They prescribe the audit strategy, the audit plans, they communicate to the component auditors. The component auditors know if they see challenges there, maybe ethical issues and those things. They are supposed to communicate to the group auditors, not taking action. Because I said, It's like so that is basically about the group audit. Now, just like the normal one, you're setting materiality at the planning stage, performance materiality. We also set what we call group materiality. Because it's a group audit, we also set group materiality. And we also set what we call component materiality. And at the group level, parent and subsidiary group audit, you're setting group materiality. And at the component level, or subsidiary level, you're setting the component auditors, they also set what we call the component materiality. Now, let's talk about audit procedures for group audit. Audit procedures for group audit. If you are auditing consolidated account, what are the audit procedures that has to be undertaken? What are the things that you need to group audit? Now, you should be able to know the difference between a subsidiary and a branch. What's the difference? What's the difference between a subsidiary and a branch? When you say a subsidiary, you need to replace it with branch. What's the difference between a subsidiary and a branch? So we can say a branch is part of a subsidiary. So it's not a separate legal entity, they can't operate on their own. But a subsidiary, yes, they are companies. They are legal entities. They can enter into contract, they can sue and be sued. They prepare audited financial statements, they have auditors. But branch is like a bank, commercial bank. Now, commercial bank, there are various branches. When I want mistaken, say a subsidiary. No. So that is it. So audit procedure 1. Compare the audited financial statement of each subsidiary or associate with the consolidation schedule to ensure that the figures have been transposed correctly and that all components have been included. So one of the audit procedures is that the various subsidiaries or figures, and a group account. Some mean that IAS 27, a can separate financial statement. 80 console separate financial statement that yakikabo. And in auditing the group, you need to pick the separate financial statement. Figures now are I say a core near a work group financial statement. 2. Review the adjustment made on consolidation to ensure that they are appropriate and compatible with the previous year. So you need to review all the adjustments. You are the auditor. The company has prepared the audited the group financial statement. And now auditing. You need to review all the adjustments. They said that goodwill, 10 million. Do the auditor, you need to audit the goodwill. How was goodwill arrived at? How did they arrive at the figure? You need to know. The goodwill, is it purchase goodwill or non-purchase goodwill? You need to know all those things. So you need to know the date and cost of acquisition of subsidiary, the purchase consideration. You need to know how the purchase consideration was determined. whether was it cash or share exchange or a combination of it, you need to know all these things. How goodwill was calculated and pre-acquisition reserve. You need to also consider the reconciliation of movement of reserves and non-controlling interest. The auditor must also reconcile any intercompany balances and eliminate intra-group items from profit or loss. Yes, I can say, in auditing the group account, you must make sure that all intra-group items are eliminated from the account. Say we move dada. The entire say we eliminate intra-group items. Why do we eliminate intra-group items from the consolidated account? Why do we eliminate it? Intra-group items.
It's kind of movement within the same entity, so I don't know how to put it.
The example is sales. You cannot make profit selling to your own self. Kind of.
Okay. So, if a parent sells goods to a subsidiary, we say a separate legal entity. In the other entity, meant to be making profit. Do you understand what I'm saying? Mm-hmm. I'm a parent. I've sold goods to a subsidiary, and you are saying I can't make profit. Is that so? But in their separate. So what is the reason why we eliminate is that at the separate level we can make profit. You can sell and charge profit. It's allowed because we are separate entities. But when we are preparing the group accounts, because the group we are the same, the moment it moves from the separate to the group level, it means that we are the same. And we can't trade within ourselves and make profit. It's not done. It's not done. But in the individual financial statement, they will recognize, the other one will recognize sales, while the other one will recognize purchases. In their separate financial statement, they will make profit. But we'll consolidate abaye one. Come to me and make it, your friend is saying, and that's a good make profit. Let me give you an example. Say, we will be more no, we are separate financial statements. We are separate financial statements. Or Bob say, or how to add it. It make it. What I say, and we are separate. But the moment Mubeba Abe one say, you have consolidating more. Or there was what you was about this kind of idea.
Yes, sir.
Oh, yes. So that is how. And
I said the women they will take it back.
Oh,
the women usually take it back. For we the men,
they will not take it back. Then you must also verify any deferred tax consequences of the consolidation and fair value adjustments. Also, you must consider the dates of the combination. You must consider the arithmetical accuracy of the consolidation workings. You must review the consolidated financial statement for compliance with the law. All these things, the auditor must check everything, all the consolidation adjustments. The auditor must review everything as part of the audit of the group accounts. Now, we have something we call joint audit and shared audit. joint audit, shared audit. Now, what's the difference between joint audit and shared audit? Now, the difference is that with joint audit, two separate audit firms conduct review of the company's financial records and they jointly sign the financial statement. So with joint audit, two audit firms, they will jointly sign the financial statement. But with shared audit, two audit firms, one audit firm will bear the responsibility for signing the financial statement. Especially this one, when there is a takeover, most of the time, say, company will pay and then take over. Because who are taking over now? Company now will taking over now a victim company. Sometimes na na womakasa auditors ni enema e wo company mu mo esene wo ti wo ba taking over. What the audit firm ba, they may not have experience in that victim company. And you need joint auditors. Or more auditors, any more auditors, number can be why auditors. That is the joint audit. But with shared audit, even though two audit firms undertake the audit, only one of the audit firms will be responsible for signing the audit report. So that's the difference between the joint audit and then the shared audit.
So in this case, who determines who signs?
In this case, most of the time, for instance, let's say for instance, the audit of the group financial statement. The audit of the group financial statement is an example of shared audit. So here, the parent auditor will sign the audit report. And now, on who I sign it, and on making sure say the component auditors will be doing the right thing, because one check or unsupervise it and review on worker. Then you should do back. Who are signing here? Who have a bear responsibility. So the audit of group account is an example of a shared audit. Two audit firms will undertake the audit, but it's only the parent auditor or the group auditor that will be responsible for signing the audit report. The advantages of joint audit, you can read it. I just mentioned the advantages of joint audit. Sometimes the client may be large, that it requires the service of more than one auditor. So because of the size of the audit, the client may require more than one auditor. Joint auditors will provide higher level of expertise. Two heads are better than one. So they can provide a high level of expertise for the work. Sometimes because of geographical concerns, we are company now scatter a lot of different places. They will require joint audits. And it's also a way of breaking the monopoly of the big four. The disadvantage is extra cost to the client. If you are involving two audit firms, you have to be prepared to pay more. Now that ICA is saying that now the minimum audit fee you can charge is 7,500. So what we did, you know,
For the minimum.
yes.
But what did they have?
Oh, I'm on the letter board. They say, I saw your audit firm. Now for charging less than 7,500, you soon.
No low balling.
No low balling.
I'm very withdraw license. It will not work. Because some of the small companies, I mean, all of us are within 7,500. It's difficult for them to pay. They can't pay 7,000.
I say either all auditors are going
Aha, so which is difficult. Because
how small can you pay?
Because obiswa for chile. so for it because so yes
You
ka
got discount.
so obi so for it na so you buy am 5,000 obey it's no there o mark about it's difficult I don't know yes I don't know the boy again. Okay, disadvantages of joint audit, the extra cost to the client. Two, there may be disagreement over the division of work. I mentioned it. When you have two different audit firms, sometimes we say policy really disagreement. Sometimes there may be inconsistencies in the audit methods. Because there are two different audit firms, they may use their different methods of audit, and that can also create problem for the work. And the other one is the problem of monitoring and controlling the audit work of two different things. Okay. Now, let's move on to our last topic. Young audit related services and assurance services. So here we are going to discuss the rest. The explaining the just read. And Babu na no na makana do you really say the makana never. Audit related services and assurance services. So that topic is very important. Audit related services with a English word. In the course of audit, audit related and assurance services. So there are some services that the audit firm enjoy in the process of audit. So last time I said, for instance, now if you KPMG for instance, they don't just do only audit and assurance. For your recruitment, my companies, they prepare tax returns for companies. All those things, they are subsidiary services. Okay, so they are audit related services. Sometimes they can decide to undertake compilation for their clients. They are able to prepare financial statements for their clients. These are audit related services. So we will consider three main audit related services. We will consider review. We will consider agreed upon procedures. And we will consider compilation. These are the three major audit related services. Review of financial statements, agreed upon procedures, and compilation. Review, agreed upon procedures. Now, because they are audit related, it tells you that the audit procedures that will be undertaken will not be as extensive as normal audit. And they are just related to audit. So, because they are related to audit, most of these you apply the normal audit procedures, but the extent or the scope of work is limited. Unlike audit work, we apply all the various applicable procedures. These are limited. Now let's talk about review. Review. You can't assume review that, but they possible. Now review is governed by International Standard on Review Engagement 2400. You don't need to memorize this. But you should know that review is governed by ISRE, International Standard on Review Engagement. 2400. Now, the objectives of review of financial statements are to 1. Obtain limited assurance, primarily by performing inquiry and analytical procedures about whether the financial statements as a whole are free from material misstatements. So, the objective is to obtain a limited assurance. Now, when we were discussing audit, and we said that the objective of audit is to obtain reasonable assurance. But here, because it is not an audit, the objective is to obtain a limited assurance. So we have reasonable assurance and limited assurance. Audit is linked to reasonable assurance, but review is linked to limited assurance. And that is why the procedures are limited. It's not like an audit where you have to spend time reviewing everything. Because this is review, the scope is limited. It says that because a review engagement provides a lesser form of assurance than an audit, the work of the review will usually be limited to analytical review. So that is what I have already explained. Now, there are 2 types of review engagements. There are 2 types. We have attestation and direct reporting engagement. Types of review engagement. 1. We have attestation. And 2. We have direct reporting engagement. Now, somebody should explain the 2. Attestation engagement, direct reporting. What is an attestation engagement? Attestation engagement.
So, who judge them?
Okay. So, attestation. To attest to something means what?
They judge them, like.
To vouch for something, or to confirm something that has been done by somebody, not yourself. So you can't attest to your own self. No. It's like bearing witness in a court. Wow, your witness is not possible. So with attestation engagement, what the auditor does is that the auditor is trying to confirm or vouch what somebody has done. So for instance, financial statement has been prepared. The auditor is attesting whether all the necessary procedures were followed in the preparation of that financial statement. That is attestation engagement. So the auditor here, after reviewing, the auditor will express a conclusion. So see that in an attestation engagement, a practitioner is engaged to attest or vouch or confirm something. For example, a practitioner might be engaged to attest the fact that certain procedures within the entity have been performed in a prescribed way. So all that we are saying is that with attestation engagement, the person will say, "Adia obi fufuro aye, a dana Paintsiwaa who follow the right procedures." No one conclusion say, "Oh, based on the nothing has come to my attention." Say one follow. That is the limited assurance. So the limited assurance starts with nothing has come to my attention. So that is the attestation. But with direct reporting engagement, it's just the opposite. of attestation engagement. Attestation, you the practitioner, you are vouching what someone has done. With direct reporting engagement, a client engages a practitioner to provide a special report on some aspects of the client affairs. The report will provide an expression of opinion, usually limited or negative assurance, that is made in accordance with the terms of the engagement. So here what it means is that with direct reporting engagement, the client will engage you, the practitioner, to perform some work, and then you will provide a limited assurance. But with attestation, will be now prepared, and I will confirm, and I will vouch it. But with direct reporting, you are involved in doing that. Example of direct reporting is just like performance audit. Those who, when we get to public sector audit, someone you do public sector, let's share we are. An example of direct reporting is performance audit. In the government sector, we have something we call performance audit. What they do is that they audit, they kind of value for money audit. What they do is that performance auditors, they are engineers. Some are accountants, some are, but majority of them are not accountants. Assess government projects, government programs. Two of them now audited Ghana Police Service on Bangalore. No matter how keep government property. So we keep in here and so we keep in here. If you over 20 years, 50 years, no more the report number, or what did the day more moving or 1 year a performance audit and an accounting. If you over roads, Nivea, performance auditors, no, they have machines, the proper tested roads, no. I should say, only the year and so 1 year. Almost see a dime contract, we see Diane, or more machines, or the check cement level, what they mean. A performance auditors, so this direct reporting is an example of performance audit. So with direct reporting, the client will engage a practitioner to provide a special report on some aspect of the client's affairs. Now, principles to apply to review engagement. It's just like the normal audit. We apply the normal principle. The code of ethics must be applied. Professional skepticism must be applied. You must have sufficient and appropriate audit evidence. And you must exercise professional judgment. Another example of attestation engagement is due diligence engagement. Due diligence is another example of attestation. Now, we all know due diligence. When it comes to acquisitions, mergers and takeovers, that is where you have due diligence, which means my audit firm. And I would employ a company to undertake what we call due diligence. Company, I would say, you need a report on their position. Report on the member who said, company, when you are so and I say, when you are so, you mean a mile of financial management. So, okay, topic there.
Performance.
A topic there. Financial management. I calculated the cost and benefit of. More fee. Mergers and takeovers, man of financial management. Synergy in Namanya. Hey, so the report of that due diligence will provide information to the acquirer whether they should acquire or not. And in doing the due diligence, it's a direct reporting. That audit firm is there. They are there to confirm. Into one review here where they don't show them sick assets. If you have hidden liabilities, checking in if you have assets now, or declare assets they are intangibles, assets. All those things they report on that. Based on that, no matter the decision. So it's an example of direct reporting engagement. Now, what items should be investigated during due diligence? And then I'm about this one. Financial performance and financial position, operational issues, identification of assets, then the benefit and cost of a takeover. Margaret. Cecilia Margaret.